Hello friends, last week I said in my video that I expect bulls to offer some support and everything was okay on Monday and Tuesday, but start Wednesday and the remaining 3 sessions of the week saw relentless declines. What's the outlook going forward? What should you do? And pay particular attention to the segment which I have introduced now, what I will be doing in the week ahead. I share my blueprint. Feel free to disagree, but do give it a shot. Let's dive right into the market, and on your screen right now is the market roundup window, which tells me that the fall was led by the banking space and the broader base Nifty brought up the rear. The US dollar index rose 42 basis points, and that was part of the reason why emerging markets, including India, felt the heat. Out of bullion, silver went down marginally, whereas gold continued to rise. Energy fell, which I have been sharing with you on my free Telegram channel as to why and what. What we saw was the USD INR, United States dollar versus the Indian rupee, fell 0.08. Now, the Indian 10-year benchmark bond yield rose 7 basis points. Now, that is a sign of concern, and it is a sign of concern for the unprepared. But I've been sharing with you on my free Telegram channel as to why coupon rates are likely to have an impact on the market and what should be your strategy going forward. So it shouldn't come as a surprise to you. NSE lost a little under 1% in market capitalization. MWPL continued to rise, and the US markets, led by the Dow Jones Industrial Average, rallied very strongly on Friday, the last trading session of the week, and logged good gains. Now, on your screen right now is the daily chart of the US Dow Jones Industrial Average, which tells you that the golden cross logged on this chart, which is the 50-day moving average, has come back above the 200-day moving average, remains in place. The 50-day average is tilting marginally upwards. The price has risen strongly on Friday. As you can see, that's a par candle, and we are back above the 33,272 levels. The last mile hurdle to clear will be the 34,281 level on a sustained closing basis. Should that happen, the US market might continue to rise. On the other side, on the other hand, trading sustainably below the 32,500 will vitiate the environment for the bulls, and the Dow might just start a decline. So monitor these two thresholds, please. On your screen right now is the Nasdaq 100 index, which is directly responsible for influencing Indian technology stocks. Here, the death cross remains in place. The 50-day moving average remains below the 200-day moving average and sloping down. Although on Friday you are seeing a good run-up in the Nasdaq 100, it's gone to its June swing low of 11,037 levels. What we will need is a crossover at least above 11,682 before we start getting optimistic on technology stocks. The broadest index of them all, the S&P 500, still remains below the inflection point of 3,905. And unless it closes above this sustainably, we should be expecting this index to remain either sideways or under pressure. Opening up the possibility of 4,120 odd levels, if the 3,905 is taken out convincingly, will be the event I will be watching. Jumping back to our domestic markets, the MWPL chart on your screen for a 20-week period shows a smart run-up to 27.28%. Now, this is a 2 marshmallow risk appetite gauge, and it tells me that risk appetite remains constant. So what we need to see is where the prices are leading the markets to. Now on your screen is the weekly cumulative turnover of index and stock futures. These are cumulative 3-month series, so it is January, February and March. What we are seeing is a sharp decline in individual stock futures turnover and a milder decline in the index futures turnover. Not really surprising. Do remember the prior week contained the expiry related turnover as well. But going forward, I would like to watch as to how much of change in volumes is occurring with the price. Now coming to the advanced decline ratio, this is the average of the 5 days of the week gone by. What we are seeing is that the Nifty has surrendered 1.36%, but the advanced decline ratio has gone down sharply from 2.54 to 0.98. Now, as I have been pointing out on my social media posts, especially on my Telegram channel, that the advanced decline ratio needs to stay above 1 with rising prices to indicate a sustained up move. Now, this is the first red flag that I've seen in the data so far. Now, coming to the basis of the Nifty and the Bank Nifty, basis is nothing but the premium or discount seen on the future vis-a-vis the spot. On a week-on-week basis, the basis, which is the premium on both the indices, has shrunk. No surprises there. Number one, they're selling at higher levels. Number two, as time passes by and expiry comes closer, basis normally contracts. As long as inversion does not take place, which means the future is not trading at a discount to cash, the bulls still have hope. Now for the impetus, which has fallen for the second consecutive week. Last week, I told you in my video that the markets rallied on poor impetus, which means the bulls lacked momentum, and look how the markets have surrendered their gains made on the week prior. But to give a benefit of the doubt to the bulls, the decline last week also was on poor impetus, which means the selling also lacked momentum. Does momentum on the downside count as much on the upside? There is a video that I have recorded a couple of months ago. Please go through that video. The hyperlink is in the comments and in the description below this video. It should help you understand what I'm getting at. Now for the LWTD indicator that many of my online family members swear by. So do I, along with the impetus. What we are seeing is that the LWTD has turned below zero for the first time after a week. The Nifty percentage gain loss line has also gone below zero. That means on declines, fresh buying support may be a little muted. As I have been telling you on social media and my Telegram channel, it is more of bear covering that was leading the markets higher rather than fresh buying. And there you have it. Fresh buying support is likely to be even more muted in the week ahead. Now, these are metrics that I update on my social media account every single day. So please do stay connected with me online and let's get conversations going, help each other become better traders. I now come to the footprint of the four market participants, starting with the FIIs, who've basically reduced their long positions in both index and stock futures, so they seem to be trimming their holdings. Where DIIs are concerned, they've cut their index short positions marginally, but they've increased their stock shorts aggressively. Do remember, DIIs buy in the cash and hedge those positions by selling in the future, so they always will appear as net short. Nothing to worry there. Where prop traders are concerned, these are super sharp guys. They know who's buying and selling, so they are next best to insiders. Now, these guys have increased their index short positions marginally and increased their stock long positions marginally. So what they are doing is taking a very cautious approach. They are taking a hedged approach. Where the retail segment is concerned, they've gone all out and increased their net long positions in index and stock futures. Do remember, this is the week after expiry. And in the expiry week, traders normally tend to cut short their positions. So a rise in both index and stock futures should not be taken as anything out of the ordinary. Friends, I now come to the four index heavyweights. Which way they swing is where the indices also tend to follow. Now, this is a study in correlation coefficient itself. Starting with the big boy Reliance, the thing that I noticed is, do remember that the weightages of these stocks changes telescopically every month. And in the month of December, because the NSE releases this data at the end of the month rather than the beginning of every month, the weightage of Reliance has gone down from 11.36 to 10.98%. And the beta has also fallen from 1.07 to 1.05. The more worrying aspect about it, and if you're a statistically inclined trader like me, the impact cost has doubled from 0.01% to 0.02%. Now, this is where what I have been advocating for the longest possible time is, do not trade those counters where the bid and offer spreads are widening. That is where impact cost tends to jump. And Reliance has just witnessed a sharp jump in its impact cost. So it's likely to impact the Nifty as well. The price is below its 20-day moving average, which itself is turning lower, which means the short-term outlook for the bulls is that of under pressure, the price remaining under pressure. We need to clear the 2,618 levels to be able to bring the bulls back onto the buy side. And unless that happens, I think Reliance is likely to either go sideways or remain under pressure. The second most heavily weighted stock in the index, HDFC Bank, it's seen its weightage go up because it relatively compared to the Nifty, it rallied versus the other stocks. It is also the most heavily weighted stock in the Bank Nifty. So whichever way HDFC Bank goes, the Bank Nifty goes. The beta is remaining constant, and so is the impact cost. But what you are seeing on the price is the price has fallen below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. The average has started to tilt downwards. Now, that is not really a healthy sign. What I would want to see is whether the 1,541 level holds. If it does and the price starts to move upwards again, all is well, momentum remains intact. If it breaks, and especially if the price starts closing below this level, bulls are in somewhat of mild trouble. Going to the third most heavily weighted stock, Infosys. What we are seeing is the weightage has come down in the Nifty. Not surprising, weightage is telescopic in these constituent stocks, as my statistically minded friends will understand immediately. Beta has also gone up, which means your bid and offer spreads and impact costs are also likely to take a hit. Just in case you believed what is being spoken in the public domain about falling rupee helping technology stocks, and therefore when the dollar gains against the rupee or the rupee falls against the dollar, go out there and blindly buy technology stocks. I've recorded a video which debunks this theory. Please do watch that video and stay away from these Pavlovian methods of trading and investing which lead to pitfalls. Infosys here still remains under pressure, and unless it goes above the 1,555 levels on a sustained closing basis, the bulls are under pressure. The last of the four index heavyweights, ICICI Bank. Not surprisingly, its weightage has been reduced in the Nifty and in the Bank Nifty as well. Price is comfortably or significantly rather below its 25-day exponential moving average, which itself is turning downward. So the short-term outlook has been vitiated, has been weakened. The 867 level was breached but not closed below it. Should this hold, well and good. Otherwise, the next support is at 836, which means the Nifty and the Bank Nifty are likely to witness some downward pressure. Now, friends, looking at the correlation coefficient between these four counters and the way the indices move, it does appear that there is a likelihood of some more decline and pressure on upsides. It does not necessarily mean that the markets have to fall sharply. It's just that at higher levels, there might be some overhead supply from traders who bought at higher levels and are willing to get out at their break-even cost, where the pain is still bearable. Friends, I now come to the bond market, which has been the crux of what I have been telling you in the last couple of weeks. And we've been miles and miles ahead of the others in the public domain when it comes to the bond market and its impact on the broader markets as well. Note how the Indian 10-year benchmark bond yield has risen 7 basis points on a week-on-week basis. I have been telling you that the time to write out a check for sovereign investments will come, and I will alert you when the time comes. And here you are. You're now at 7.37%, within a kissing distance of 7.50. Would you write out a check there, or should you write out a check there? Or more importantly, will I write out a check there? I will post that in my Telegram group as and when the time comes. But do remember how the coupon rates are rising rapidly, sometimes twice a month. That should tell you, to somebody who understands bond convexity, that should tell you where we are headed for equities, commodities, and currency markets over the next quarter or two. Now, with the increase in interest rates on small savings schemes, especially India Post and National Savings Certificate and senior citizens deposits, etc., and TDs, which is term deposits under the sovereign investment schemes, what you are likely to see is that the bond market will play a larger role in the overall financial market scenario, the landscape. And those who don't understand the bond market will have a natural disadvantage against those who do. And especially if you're a trader in the Nifty, Bank Nifty and banking stocks, not knowing what the bond market is saying can put you at a serious discomfort. Now, do I expect the yields to go up? Yes, I expect the yield to go up. Do I expect it to cross 7.50? I'm sort of banking on it because I want to write out a few checks. The bond market done. I now come to the US dollar index, which has been one of the reasons why the emerging markets, including India, fell last week. What you are seeing is a net gain of 42 basis points of the US dollar index, the Dixie. It fell on 3 out of 5 trading sessions, the Friday's fall being the most prominent. But Thursday's gain was also very, very noteworthy. The price attempted to go past its 25-day exponential moving average, which is a month-long holding on cost of a bull, but failed. The more it stays below the 104.51 previous swing low pivot, the greater is the probability of testing the 102.75 or 103 level. That's something I have told you in the last 2 weekly videos. And if the US dollar index is to fall, it will be positive for emerging markets, including India, also for bullion, and it might also raise the price of other commodities as well. Take a look at the weekly chart on your screen. The price is below its 25-week exponential moving average, which is a 6-month long holding on cost of a bull. So the medium-term outlook remains under pressure. What you are seeing is an inverted hammer, and that tells you that the bulls attempted to pull the prices higher but failed. The price settled in the lower end of the weekly range. And unless serious follow-up buying support comes in, I would expect the US dollar index to remain under pressure in the week ahead. Friends, last week I advocated a range between 105.72 on the upside and 101.26 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I expect a range between 106.20 on the upside and 101.62 on the downside. Friends, the dollar index done. I now come to the Bank Nifty, which surrendered 1.86% on a week-on-week basis. It fell on 3 out of 5 trading sessions. What's noteworthy on the daily chart on your screen is that all was well on Monday and Tuesday last week. Come Wednesday, downward pressure really spiraled out of control and the downward momentum built up. The price has closed below its 25-day exponential moving average, and the average itself has turned downwards marginally, which means all recent buyers, all recent bulls in the Bank Nifty are now under pressure because the price is below its month-long holding on cost. The 41,840 level is a level to watch out for. Should the Bank Nifty start trading sustainably below this threshold, you might see more unwinding because of LIFO, last in, first out, which means the most recent traders who purchased the Bank Nifty will start to cut their recent positions down. Going to the weekly chart on your screen, what you are seeing is in the week prior, we saw a bullish piercing pattern. I pointed that out in my video last week, followed by a bearish piercing pattern, which means the bullish candle of the week prior was pierced by more than 50% of its body downwards by a bearish candle. That tells you that there is extreme amount of volatility. A bullish piercing candle followed by a bearish piercing candle, that's the price thrashing around, which is why I wrote in my live mint column, make haste slowly. Don't be in a hurry to make money in this market. It's not going to be easy. The price remains above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook still remains optimistic for now. Friends, in the week before last, Bank Nifty was at number 3 on our most volatile counters list that we maintain in-house. It fell 2 notches to number 5, which is good news because lower volatility is always good for a retail trader who can't really handle extreme bouts of volatility. Last week, I advocated a range between 44,375 on the upside and 41,600 on the downside, which held perfectly well. In the coming week, I expect a range between 43,600 on the upside and 40,775 on the downside. I continue at the risk of sounding repetitive. Please trade light. Make haste slowly. Coming to the Nifty 50, friends, which surrendered 1.36% by falling on 3 out of 5 trading sessions. As you can see on the daily chart on your screen, this was exactly the way the Bank Nifty fell. The fall started on Wednesday and continued through Friday. Note how accurately the price has fallen just from its 25-day exponential moving average. That tells you the importance of the 25-day exponential moving average. It's a month-long holding on cost of an average bull. What it tells me is that guys who are reaching their break-even point on their trapped long positions are exiting at higher levels. This is another red flag for the markets right now. Coming to the weekly chart, an exact replica of the Bank Nifty where we are seeing a bullish piercing candle of the week prior being followed up by a bearish piercing candle last week. That tells you that momentum is extremely volatile and sentiments are fickle. Price remains above the 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. Mean reversion is now complete, where the price meets the moving average. If the price falls below the moving average, it would then turn to negativity from mean reversion. Will it happen? Time will tell. We'll need to watch. In the week before last, this index was number 12 on our most volatile counters list as per statistical beta. It rose 2 notches to number 10. Now, that's not good news at all. Rising volatility does not help a retail trader. To the savvy, experienced trader, yes, but a retail guy, no. Last week, I advocated a range between 18,600 on the upside and 17,600 on the downside, and it held. Note how both the indices, the Nifty and the Bank Nifty, the supports and resistances were kind of holding within 100-200 points of the advocated levels. So that is a very good track record to have, basically. In the coming week, I expect a range of 18,350 on the upside and 17,375 on the downside. Here again, please trade light. Friends, now for the last bit of statistical inputs here, we are going to measure the retail traders' risk appetite by their footprint in the index stock and futures and options. The more they are taking positions in futures, the more the risk appetite, and within futures, the higher the exposure in stock futures, which are more volatile compared to index futures. That's extreme risk appetite. So on your screen right now, what you're seeing is a daily chart of a 20-day look back bias. The stock options turnover has hit a few week high. So risk appetite in the option space in stock was there. The olive green line tells you the turnover contributed by stock futures as compared to the overall turnover remains muted. So where retail is concerned, they are getting into stocks, but they are not buying futures. They are buying options. That tells you that they are actually on the back foot. They are not as gung-ho as they should have been. What are they doing in index futures? That's the red line. That's more or less flattish. So here again, even though indices are less volatile than stocks, they are not really raising their exposure much. Let's take a look at what they've done in index options. In index options, what they've done is taken a greater degree of exposure as compared to last week in index options. Do remember, this segment contributes more than 70%, more than 95% of the total turnover on the F&O space on the NSE. So there you have it. The secret is out. Traders are preferring to basically play it very, very safe and play in the index options rather than stock futures, stock options, or even index futures. People are scared, which is why I told you make haste slowly. Friends, now I'll share with you my thoughts about what I would do next week. Feel free to disagree, but in case it helps, I'm willing to share my thoughts with you. I plan to ride the theta decay wagon. That means I'm betting on the fact that options premium will contract, especially on the long side on interest rate sensitives. Why? Because the answers are there in the Telegram channel. I've shared with you some pretty detailed, long editorials that I've written in the last 2 months on this issue. And I'm also bearish on energy commodities. Here again, I've shared the reasons why. I don't just believe in giving out a direction. I don't recommend trades. I don't recommend stop loss, target, entry levels, etc. I am giving you a broader picture here, but for the sake of understanding, I also like to share the reason why, so that you learn how to think rather than what to think. So energy, I don't mind selling, but since the prices have come down so sharply, I will not blindly go into fresh short positions. I would want the price to go up a little so that my risk perception, threat perception reduces. I would sell the rallies rather than sell the declines. Friends, so that's so much for my blueprint next week. I now come to the most popular segment of this video for statistically minded traders, wherein I give you 5 stocks where impetus has risen the most on Friday. So you take small exposure, wait for large price move, and 5 stocks where impetus has lost the most on Friday. So you take big exposure on Monday and wait for small price move. This is for scalpers. If you want to be updated with this list Tuesday through Friday, please subscribe to our free Telegram channel. We don't charge you anything there. We don't charge anything for anything at all. So you can stay ahead of the curve by utilizing our statistical data models. I now start with the impetus gainers, where you take small exposure, wait for large price moves. The list is led by HDFC Life, number 2 MFSL, number 3 Infi, number 4 TCS, number 5 Bajaj Finance. Do remember, I've written a special editorial on the Bajaj twins, Bajaj Finance and Bajaj Finserv. Do make it a point to read it on our channel as well. The impetus losers list is led by UPL, followed by Adani Ports, Dr. Reddy, ACC, and Lupin. Friends, I hope my videos are making a lot of difference to your trading. Also, watch the shorts that I have started putting up, 1-minute videos on our channel, and help me reach out to smart fellow like-minded investors and traders like yourselves by sharing my work in your friends and family across social media groups. Before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, do let me know what you think of my work and what I can do to make it even better. I thank you for your patience and sticking around in this video. Till we meet again in my next video, This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Bye bye. Take care.